All right, so good afternoon. Most of the times when you see these YouTube videos that I put up, it's me sitting in here in the office alone, but this afternoon we're going to do something a little bit different. One of my favorite people in the middle of this whole foreclosure, fraud closure battle is a guy by the name of Michael Olnick. Now, Michael and I met a couple of years ago when he first drew my attention to a very unusual stock transaction, or a transaction going on with the Securities and Exchange Commission. We'll talk about that in just a moment, but what I want to talk about today is something that recently got my attention all over again, which just coincidentally Michael had been digging into, and that is the alleged returns of the retirement fund held by the state of Florida in their retirement fund account. Full disclosure here, I am fairly unfamiliar and frankly ignorant of all things Wall Street. Some people say that's part of my charm, my ignorance in these areas. And so that's why a guy like Michael is very helpful to me, a smart guy that can tell me a little bit about things and explain to me why I don't know. So, Michael, tell me a little bit about your background and then refresh my recollection of how you and I got to know each other.
Sure, Matt, I'm happy to. First of all, I'm really more of a business person. Though I was sent to law school, I'm a computer programmer and I'm an entrepreneur. I built and sold 3 companies, the Fortune 500 companies, and I was working on another. When I was much younger, I was working on software to ease the process for securities disclosures from paper to electronic, and the company I was working for sent me to law school. I never really intended to practice, but it was helpful to have that background to be able to help write software to aid in that transition. So I've kind of been able to fuse the two of them together, and that's what I really have spent my career on, is computer programs that help take complex information, distill it, find information about it, and bundle it up, whether it's for regular consumers, for attorneys, for businesses, or for whomever. And that's really kind of how we came across each other.
What did you first think of that transaction involving a certain law firm in the state of Florida?
Sure. David J. Stern's DJSP, and what we should do is just back up a little bit with kind of what he did and where he came from. So Stern says he was the largest foreclosure filer by volume in the state, and a number of firms have taken what they call their back office operation, which is functionally the entire law firm except for the litigation, actual litigators, and they've spun them off into separate businesses and even gone so far as to take those businesses public. Now, there's companies that do this type of work and do it legitimately. The company who sent me to law school that helps people create these massive SEC disclosures. I won't say who they are, but they're a completely legitimate company. There's mounds of paperwork. If they're putting it together and assembling it and having computers help do that isn't unreasonable. What is unusual is this. Back in that day, the computer systems were there to look for what we call exception reporting. That is, they were going through astronomical amounts of information and data, and they would help find errors that people had put in. Whereas with the foreclosure mills, when they seem to make these, they almost seem to go the other direction. Rather than having their systems report errors, so they could be corrected and flagged by lawyers and accountants who might not see them in all this information. They seem to consistently and repeatedly make errors, and this shouldn't be happening. Stern decided to break off his back office company, and he called it DJSB, David J. Stern Enterprises, and bring it public. Everything about the transaction was a little bit iffy. First of all, it started out as what we call a reverse shell transaction. So normally when a company goes public, they say, hey, I'm making a lot of money, and they file a bunch of paperwork, and investors come and buy their shares. Instead, Stern, what he did was he took some money from what was already a traded security called a SPAC, special interest, basically a kind of one-trick pony that was created just as an investment vehicle to buy factories in China. And he renamed it DJSP and said, okay, this is my stock, along with the money that was in there for the Chinese factory acquisition, will now be the back-end office of my foreclosure mill. attracted my attention, like it attracted the attention of many others. And as I dug into that, you dug into that, all of us dug into that, it just raised more questions than it answered. And the more we dug into everything from his public disclosures to what he was telling investors in conference calls, the more we saw a pattern, which we know from Stern's other work, and that was he was being anywhere from overly optimistic to just flat out lying.
And one of the things that
right before one of his quarterly statements, he told his investors, literally days before, he told his investors that filings were doing great, everything was fine. I saw it in my own databases that overall Florida filings were down, Stern's filings were down. When that information came out a few days later, his stock price plummeted, and we kept talking to these investors. But the same types of behaviors that we saw from Stern in foreclosure court, we also saw in basically the operation of his public company. Unfortunately for Stern, public investors are a lot less forgiving than foreclosure judges, and they quickly both bankrupt him as well as for the first time in 10 or 12 years, it was brought to the attention of his clients, many of whom from the trading side of their operations were also investors in DJSP who lost a lot of money. They all of a sudden perked their ears up and quickly basically shut down not only DJSP, but also his law firm.
And Michael, one of the things that still blows my mind about the discussion you just had there is that all of this information is public. In fact, I'll attach to this video blog the link which will direct directly to the Securities and Exchange Commission and the filings that are with the Securities and Exchange Commission that detail basically everything that you just said there. And one of the things that blows my mind is kind of like the Madoff situation, where this has been known for years now, and I'm not aware of any enforcement action or any other consequence that's happened as a result of this. Are you?
No. Stern hasn't even been disciplined by the Florida Bar. They say they're working on discipline for a bunch of Florida lawyers. I mean, everything about this transaction, everything about it was iffy. The lead funder, the man who put it together, was an early investor in Global Crossing, which ended up being one of the biggest bankruptcies in U.S. history. The Chinese, the people who are investing and buying factories in China, it was never clear why they diverted their attention from doing that to buying a foreclosure mill. There's obviously, you're not allowed to take law firms public. Only lawyers can practice inside law firms. So whereas certain high-end kind of paperwork stuff like securities disclosures, that is really not the practice of law. It's more, regular accounting practices. But creating pleadings for lawsuits, that sure sounds like the practice of law to me, and it's not the type of thing that you could do in a public company. Every single piece of this just stung. The SEC did continually require Stern to file amended prospectuses so that he could trade his stock, but they didn't put the brakes on, and they really dropped the ball. I mean, just like other regulatory agencies have, a lot of people lost a lot of money thinking they'll get rich on foreclosure through DJSP.
And it just blows my mind that here we are years later and nothing's happened. And, one thing that just jumped out at me, again, as somebody totally unfamiliar with all the fancy Wall Street ways and machinations, is the very first page or so of that prospectus where it says it's a blank check holding company for a corporation operating out of China. I mean, that just sounds bizarre to me. And frankly, if you can't read it with your own eyes, I don't think people would believe you.
It sounds literally unbelievable, and it just gets nothing but crazier as you read through page after page of that information. The amounts of money that Stern is making, the amounts of money he plans to take out of the company. It's not uncommon for people to take money out of the company when they take it public, but when it goes public regularly, there's something called a blackout period where the top investors, like the founders of the company, they can't take money out of the company just so that exactly what happened doesn't happen. You have to sit there and say, look, if it's going to sink, my own money is going to sink too, where that didn't seem to happen. Stern walked away with.
Well, and look, it's it was years ago that you and I was writing about this. This is sort of old news of years ago. Just it's again staggering that nothing has happened in all of these years, and we've moved on to more and more and bigger frauds and problems with still nothing happened. But that's a great background. You and I could talk more and more about that. Maybe some regulators, some investigators, some government official, or somebody might sometime pay attention to that. And you know, we still see the carnage left in courtrooms. I still have files on my desk here that are part of the carnage left when that law firm blew up, and hundreds of thousands, literally, of files were just abandoned in courtrooms all across the state of Florida. But maybe we'll do a follow-up at some point in time. The thing I wanted to talk about today was the post that likewise is linked directly beneath here, and that is I came across an announcement from the Florida retirement system which purported to show a return of 22% on the investment portfolio of state workers. And a little bit more description here. As I understand it, state workers, whether you're a teacher or a cop or a judge, invest a certain amount of each of your paychecks into this retirement fund. And according to the information released by the state, that retirement fund has assets of about $128 billion. And what I found most staggering in this release is the Florida Retirement System's pension fund said that they gained, drumroll please, a 22% increase in return on their last release. Now, can you help this babe in the wood, this guy that doesn't understand the stock market, how that's possible? Help me understand how that's possible?
It does happen. I mean, people do make great returns sometimes, but what usually happens is that they have very detailed disclosures showing exactly what they purchased, why it went up, what they sold, why it went down, how everything balanced. And as we began to dig into this, and for full disclosure, we haven't, you could spend months auditing something like this, and we haven't done that. We spent a little bit of time, but it's very unlikely to have a 22% year-over-year gain, especially in an economy like this, especially like something like a pension fund that mandates extremely conservative investments. I mean, the stock market overall, the S&P is right now down 1%. That is, the overall market, 500 biggest companies in the country have overall gone down 1%, yet the Florida pension fund is saying that it had a return of 22%. That alone is a little bit suspicious. It raises some red flags. But what really raises red flags is the background of the Florida pension fund. If we remember back a few years ago, this is the same fund that being advised by Lehman, right after Jeb Bush left office. He was working as a Lehman advisor, purchased a series of Lehman CDOs, that is, a series of bundles of mortgages that were initially ranked as non-investment grade, as bad mortgages, but which rebundled and through some chicanery with the ratings agencies were then relabeled as investment grade. Florida purchased these, and within 4 months they fell apart. They lost virtually all their value, and that set off a mad scramble by counties all over to reclaim the money, to pull it out. That forced the Florida pension fund to freeze its money, and it's really been a mess ever since. The idea that it's kind of the same group of people, I mean, the man who was leading it there left, but we have to assume there hasn't been total staff turnover. And
But Michael, how can the state or the investment folks working for the state issue a release which, if my plain reading of this English is correct, the release says the Florida retirement system increased their holdings by 22%.
Had an increase in the value of their holdings by 22%. At some point, you would that they bought it, and that they were brilliant investors in a year when the overall state system was, or overall business climate is down 1%. That they instead managed to get a 22% return. But we know from just a couple of data points that we've looked at that just looks seriously iffy. One of the biggest is that those spun off CDOs, those bad mortgage pools, were put into a separate portion, which is rolled up into this big portion, and they very clearly say that they are guessing on the value of those loans.
That's great. So they're able to guess on the value of the loan. Now, one question I have as a foreclosure defense attorney who sees plaintiff foreclosures all the time, I'm looking down this rather detailed list here, and I'm seeing Bank of America, Bank of New York, BB&T, Citigroup, Deutsche Bank, all of the regular players that come across my desk every day. And I wonder, are they counting the value of these mortgages based on the face value of the note, $200,000, say, or are they recognizing the fact that if this thing goes through foreclosure and they sell it, that property or that asset isn't worth $200,000, it's worth a liquidated value of $50,000 or something like that? How do they count this stuff?
They're absolutely not doing that. That was one of the changes that came about in the 2008 meltdown, was we changed the accounting rules, allowing banks to move from what's called mark to market, which is the real value of something, to mark to model. And mark to model literally just means they guess. We're going to take a wild guess based on some formula that typically isn't disclosed. In fact, I've never seen one disclosed, so I haven't.
All right, so the bottom line is we're dealing with numbers that are, if we want to be optimistic about things, we'll say that they're optimistic numbers. If we want to be more realistic, we might just say that they're fantasy. Is that closer to what you think reality is?
Absolutely accurate to say. One thing that you've seen, Matt, like other foreclosure defense lawyers, is you have seen banks repeatedly delay sales, even when your client just wants their house sold. They're like, we're finished, we're done, we want to move on. You've seen banks stonewall you in litigation, and the most likely reason is they don't want to have to mark those losses. They don't want to have to say, okay, they could pretend their mark to model is accurate and their $200,000 loan is worth $198 or something, but once they foreclose and the house is sold and it's done, then they have to take that $150,000 loss.
And I got to tell you, Michael, I've been in court many times where the judge is trying to move something along, maybe a pretrial or maybe their foreclosure sales that have been set, and there's nobody on the other side defending it. No foreclosure defense attorney, a homeowner hasn't even filed anything, and yet the judge wants the case to go forward, and they got plaintiffs in there that are canceling sales and refusing to make it go forward. So are we speculating that part of the reason why these banks don't want these cases going forward, in addition to they just don't want to hold more property, is in addition to the costs they would get if they got the property back through foreclosure sale, they would then have to come clean regarding the real value of the assets in their holdings. Is that correct?
Absolutely. Not only would they have to come clean about that specific asset, but at some point when you're starting to write down a lot of houses, especially in the same geographic area, you have to change your models. I mean, mark to model, even with a wink, wink, nudge, nudge. At some point, it can't be completely off base. You're going to get sued by all your investors.
And Michael, one of my, again, biggest frustrations is, I say it repeatedly, I'm not a free house guy. I think people, most of my experience, my clients want to be making some kind of mortgage payment. There's a buy-in. There's an ethic that people want to be making mortgage payments. But they cannot get a fair deal out of the bank. They can't even get the bank to negotiate with them. I just had an attorney come back from a mediation, and like most mediations, it's not successful because the bank won't negotiate in good faith with the homeowner. So if I'm an employee that's invested in the Florida retirement system, I would be looking at all of these banks and institutions and frankly looking at these foreclosures and asking myself, why won't these banks work? I mean, you've kind of answered the question why the banks won't work with people, but I would be forcing a more realistic settlement, and that would be forcing homeowners to be making homeowners payments and paying insurance and paying taxes and not allowing the banks to not work with people. So if I were looking for real-world practical solutions, I wouldn't be looking at how to speed foreclosures along more quickly. I would be looking at how can we start generating money for these mortgages and these homes and paying the trust. Does that seem like it makes a little more sense?
Absolutely. You know who is, ironically, the strongest advocate of principal write-down? He never waver on this, and he goes so far as to favor principal write-downs below, sometimes it's substantially below fair market value, and if a homeowner can't afford that, if a borrower can't afford that, to move the mortgage into a nearby empty that they can't afford. So if somebody, bought a 5-bedroom, they can't
Right.
afford that, the values are dropped, move them to a 3-bedroom down the block. So he says you should, this is an investment banker named Lou Ranieri, and Ranieri is famous because he invented the mortgage-backed security. This is the inventor, the creator of the mortgage-backed security, unambiguously says, he screams, never foreclose. It is financially the worst thing you could do. You add up all sorts of expenses. You take a giant hit to your portfolio. It doesn't make financial sense. You end up with cranky customers. You ruin their credit, and that affects all the rest of your banking operations. This isn't someone like I've become now. I'm much more of a homeowner's advocate. You're obviously a foreclosure defense lawyer. Ranieri is an investment banker, and he's not like a low-level investment banker like out of the woods. This is the creator of this market, has been absolutely adamant from the earliest days, don't foreclose. Do anything you can to avoid a foreclosure. Write down the principal. Figure out something that works. Go so far, like I said, as to move your borrower into a nearby empty. Do not forcibly take homes except as an absolute last resort if somebody won't work with you. But we're seeing exactly the opposite.
All right, Mike, so we're going to kind of wrap this up here, but that's a great perspective because on the one hand, you got myself, a dedicated consumer advocate, saying the best thing is to keep homeowners in there making payments, and on the other side, you got the investor advocate making the same argument that we got to keep people in houses paying. It stabilizes communities. It's good for the investors in the long run. And yourself, sort of an analytical guy with a background in finance, saying that's the right thing to do. Now all we got to do is convince all the other people in this country that makes economic and rational sense. I want to thank you much. I'm going to try and get this thing posted up pretty quickly, and I'll include underneath it the links to this information about the Florida retirement system and other links as well, and you'll provide a little background on there. But thank you very much for calling in and chatting with me about this.
Okay, thanks so much for having me on.
See you.